Hello everyone, let's start with our next category of ratios, that is gearing and risk ratios. And the first ratio over here is called financial gearing. Now financial gearing tells us what's the level of risk the company is facing, that's the risk of insolvency the company is facing due to its high debt burden. Now it's obvious that the more debt there is in the capital structure of a company, the more risk it faces for insolvency. Let's read out loud and look at the formula. Financial gearing tells the risk the company is facing due to high debt burden, which I've just told you. After that, we have got financial gearing formula, which is debt over debt plus equity multiplied by 100. Or financial gearing is debt over equity multiplied by 100. Both formulas are acceptable in the exam. The examiner will specifically guide you if it wants which formula it wants you to apply. However, if the examiner is silent, you can use either formula and you can get full marks. The debt over here is long-term loans plus preferred share capital, and equity over here is ordinary share capital over plus share premium or retained earnings. Now, most students often forget that the debt over equity formula also includes preference shares, so do remember that. Let's apply this formula in our extract. Now we are doing gearing ratios, and first ratio that we are doing is called financial gearing. Now we are using the formula of debt over debt plus equity multiplied by 100. Okay, so the debt over here is 500. Here it is for 2019, that is. And equity is over here is this. $1,500 plus 620 will give you 2120. Now if you compute that and multiply with 100, we get approximately 19% for 2019. Now doing the same for 2018, we get the debt for 2018 was 450 plus the equity is 1500 and 448, which gives us 1943. Multiplying with 100 will give us 18%. Now comparing 2019 with 2018, you can see that there is a slight increase in financial gearing, and the reason is straightforward, can be seen from the extract of the financial statement, that the debt of last year 2018 was 450, when current period was 500. It means that around 50 million additional loan was obtained, which is evident with the ratios that we have just computed. So the company needs to do something about that. Increasing gearing level is not a good sign for any company. It must keep a balance. However, if it's using the funds and the generating returns beyond the cost of raising this finance, it's acceptable. Let's see what's the next ratio that we are doing. The next ratio that we are doing is called operational gearing. Now, operational gearing shows the risk the company is facing of making low profit due to high fixed costs. Now, in the last ratio of financial gearing, we were focused on the impact of debt that was the main focus. Here we have got an impact of fixed costs. Most people don't agree with it, but fixed costs does have a great positive or negative effect on the company's operation. If it's a small startup, it's obvious with the variable cost the company will be making profit, but if it's a higher fixed cost, for example, the premises which they are using for the manufacture, it's somewhere in the city, is not outside the city, obviously the fixed cost or the rental for that premises will be high as compared to the premises outside the city, resulting in higher proportion of fixed costs. In spite of the fact the company is making profit or the products are making profit, it might the most of the profit might be wipe out due to the high proportion of fixed cost. So we need to keep the businesses must have a strategy to keep the fixed cost at a moderate level, not so high, not so low, but at least in a moderate way, which is a business norm. So it shows the risk the company is facing due to of making low profits due to high fixed costs, which I've just told you. Now, operational gearing can be computed in a number of ways. The examiner will, this depends upon the data examiner will be giving you in the exam and will be guiding you with. For the sake of learning, we will be computing all of these with the Henrico extract. So let's see what the formula we will be applying. Operational gearing, contribution over profit before interest and tax. Contribution, if you're not familiar with, it's a management accounting term, which is sales less variable cost. After that, we have got an operational gearing, fixed cost over total cost. Then we have got an operational gearing of fixed cost over variable cost. So let's compute them in our Henrico extract. Okay, for this purpose we need to break the variable and fixed proportions of total costs. So we are taking an assumption over here that 70% of cost of sales and 10% of expenses are variable cost. So all we need to do is make a chart over here to separate the variable and the fixed proportion of the cost. Let's for 2019, let's do that. We have got a variable proportion and then we have got a fixed proportion. I'm using the symbol like a space. Then we have got a 70% of cost of sales. The cost of sales for 2019 is 300 multiplied by 70%, we get is 210. Now the remaining portion, is quite obvious, will be the fixed element. After that we have got expenses. If you compute the total expenses, we need to get the 10% of it, and the 10% of total expenses will be, these are 90 and multiply by 10%, we get 9 is the variable proportion and 81 will be the fixed proportion. Now totaling each of them, the variable portion will become 219 and the fixed proportion will become 171. Alright, this is our chart. Let's do the same for 2018 as well. Uh, 70% of 280 will give us 196 and the remaining element of 84 will be the fixed proportion. After that we have got if we total the all the expenses, the 10% is 8, it's approximately 80, and 74 will be the total variable cost is 204, the total fixed cost is 158. Now all we need to do now is to use the formulas. Okay, the first is contribution over PBIT. We all know what the contribution is. It's sales less variable cost. So let's put that. The first formula was the contribution over here. Let's compute the contribution. The sales is 500 and the variable cost is 210. And the profit before interest and tax is 160. Computing that, you will get around 1.75 times. After that, doing the same for 2018, we have a total contribution of sales as variable cost. That's sales of 450, that's variable cost of 204, will give you 246. And the profit before interest and tax for 2018 was 133. This is give a 1.85. So the fixed proportion has reduced. If we look at the contribution over PBIT, it has basically reduced. So it's a good sign. Let's do the same with another formula which we have just read, as fixed cost over total cost. The fixed cost we have already computed for 2019 is 171. It's the total proportion of fixed cost, and the total cost is quite easy to compute. All you need to do is add the variable and fixed proportions. And for this, if we add 171 with 219, we get 390. And if we divide that and multiply with 100, you'll get a 44%. Doing the same for 2018, it's 158 over 362. Multiply by 100 will give you 43%. The last formula for operational gearing was fixed cost over variable cost. Let's compute that also. Variable cost. The fixed cost, if we have already computed, is 171 and the variable proportion is 219. Doing the same and applying 100%, we get a 70%. Again, the fixed cost over variable cost. $204 was our variable cost. multiplying with 100 will get 77%. So there is, you can clearly observe there is only a slight increase when we are in the fixed cost over total cost. The fixed cost over variable cost, we are talking about the proportions of fixed and variable. Just like in the capital structure we talk about debt and equity, in management accounting we have got something like fixed and variable proportions. So comparing the fixed and variable proportions of the cost, there is a slight increase, but this slight increase of 1% is not material. In all course of businesses, this sort of increase is happen on a routine basis, increase or decrease. So we can now say the company should have a management of these costs, so that they might not get out of control or became out of the company's policy. So that's it for operational gearing. Let's look at our next ratio. We'll be doing these examples in our last video. We have got an interest gearing. Now interest gearing shows how much amount of interest payments are absorbed by the profits in terms of percentage. It's basically telling us that what is in terms of percentage, what's the proportion that is absorbed, that is taken by our loan providers, the higher the proportion they are taking from a loan, which means the less is available to show or distribute, to show in the P&L as profit or for distribution to the shareholders. And putting that in our extract, we need some space. Now we are doing interest gearing. Which is finance cost over PBIT. Now finance cost is 50 that's from P&L, and the profit before interest and tax we have computed is 160. Dividing and multiplying with 100 will give you 31.25%. Now doing the same for 2018, we have got a 45 of finance cost, and profit before interest and tax was 133. Multiplying with 100 will give you 34%. Now the interest gearing has reduced, which means it doesn't mean that the interest payments have reduced. It means that the proportion of profits which we have generated by using that finance is way beyond the interest payments that we have to pay to the providers of finance. As a result, our interest gearing has decreased. The last, coming to the last ratio, that is interest cover. It's basically the opposite of the interest gearing which we have just completed. Interest cover, if you look at the formula, we were comparing finance cost with profit before interest and tax. Now we are doing the reverse. This formula is in ratios, so what we will be getting is in times, is in the proportion, so we will be getting it in times. What this tells us is that how much times that the company can pay its interest costs, provided all other elements remain same, provided the interest cost remains same. For example, when it costs 50 and we are making a profit of 200, we can pay the interest 4 times from our profits. So we can borrow even more funds from the profits perspective, which are subject to fluctuations. So let's compute that. It shows how many times the company profits can pay the interest cost in times. Now we have got a interest cover. Let's use some space. Yeah. Now we are doing the opposite, which we have done above, that is PBIT over finance cost. This ratio then times, so it becomes 160 over 50, and it gives us 3.2. Last year it was 133 over 45, it was 2.9. So the interest cover has improved, which means the there is a slight increase in interest expenses, as we can see from the P&L. However, the profit which we have generated is quite high, and that's why our interest cover has improved. So that's all for gearing and risk ratio. Moving on to our next category of ratios, that is investors ratios. Coming back to our notes. So investors ratio, the first ratio that we will be doing is EPS. It shows the profit earned per share. EPS is a basic formula you must be familiar with. It's earnings per share. It shows the amount of return each share has generated. So let's compute that on a financial statement extract of Henrico. First, let's just read out the formula. That's profit after interest and tax less preference dividends. Most people forget about that. That's preference dividend over number of shares. Number of shares is simple. We need to take certain assumptions to compute that in our Henrico extract. Let's move on to a new extract. Now we are going to do investors ratios, and the first thing that we are doing is EPS. Before that, we need to take certain assumption in when it comes to investor ratios, because these ratios have to be computed using a market share price and also the share price of the equity plus the proportion of dividend that the company pays. So let's first discuss about the assumptions. It's our equity is $2 each. Our market price is $3 per share. That's our market value. And Henrico's pays dividend, which is 50% of profit after tax. Whatever it earns, it pays 50% back to shareholders. It's a nominate in a company to keep a certain percentage for itself for financing of future projects. So first we have got an EPS. It's profit after tax less preference dividend divided by number of shares. For 2019, the profit after tax is 77 and the preference share is 0, and divide by number of shares. Now I've already told you that each of the share is 2 on the value, so 1500 divided by 2 will give you 750, straight computation. but I'll write it for your ease. 1500 is our equity divided by $2 each. Now computing the denominator, you get 0.102. Now this ratio is in dollars, in currency terms, so that's the amount of EPS, earnings per share. Each share has earned this much return. Doing the same for 2018 is 62 over 0, and then our equity was same, 1500 divided by 2 last year. This will give you 0.082. Now from this ratio you can see that our earnings per share has improved, which is also evident by more profit figure onto the in the 2019 PNL. So that is for EPS. Most of the investment ratios are straightforward and does not require a vigorous interpretation, but still most students do them wrong in the exam. I don't know why. The next ratio that we are doing is dividend cover. It shows how many times the company can pay dividend out of its profits. Dividend cover is profit after interest and tax divided by dividend paid or to be paid. Now let's do that in our computation. We are using a dividend cover. Now just like the interest cover, this ratio is also in times. You can remember that whenever the cover comes, the ratio is in times. So our profit after tax, let me write the formula first. That's dividend cover is profit after tax divided by dividend paid. Now profit after tax for 2019 was 77, and dividend to be paid, we have just taken assumption that is 50% of PAT. So we are doing a 50% of PAT, that is 77 multiplied by 50%. If you compute all of this, you'll get an answer of 2. And doing the same for 2018 was 62 is our profit after tax, and the 62 multiplied by 50% is giving us again 2. It's a tie, which means that the dividend cover from last year to the current year is same. The company has maintained the same dividend cover across the years. Moving on to our next ratio, that's dividend yield. Now this ratio shows how much a company pays out in dividend each year relative to its share price. The formula for that is dividend per share divided by current share price multiplied by 100. So let's compute that. Now we have got a dividend yield. The formula is DPS, dividend per share, divided by current share price. Now dividend per share is quite easy to compute. It's 38.5 is the level of the dividend, which is 77% of 77 If you compute 50% of 77, that's 38.5, and we need to divide that with our total number of shares. That is, in this way we will get a DPS, dividend per share. That is divided by our total number of shares was 1500 divided by 2 is 750, and we need to divide this with our share price. We already know, we have taken the assumption that the share price for 2019 is 3. And if you compute all of this, you get an answer of 1.7. Now doing the same for 2018, that is 31 divided by 750. Now the last year share price was 2.45 on the assumption, and if we compute all this, you get 1.65. So the dividend yield has slightly increased. The company is paying more to shareholder when comparing to the share price. However, there is no significant increase. It's only 0.05 increase. So it's quite nominal if you ask me. However, there is an increase in terms of ratio when we talk about the ratios. So that is for dividend yield. Moving on to our next ratio, which is also one of the examiner's favorite ratios, and that is the PE ratio. Remember, whenever the examiner wanted to increase the level of difficulty in an exam, it always uses this ratio as a creator of difficulty part. That's what I've observed from the past paper. P ratio gives an idea of what the market is willing to pay for the company's earnings. The higher the PE ratio, the more market is willing to pay for the company's earnings. PE ratio basically shows the level of confidence that people have in the company. The higher the PE ratio indicates the more confident the people are and the more money they are paying for the company share. This is what this ratio shows. Let's compute that. Now we have our PE ratio. It is share price over EPS. EPS stands for earnings per share. We have already computed that. This was our first ratio of the investors ratio category. Share price we already know is 3, and we have computed the EPS, which was 0.102. We have also let's compute that. 3 divided by 0.102, you will get an answer of 3 divided by 0.102 gives you 29, and 2 divided by 0.082 is 24. So it has increased. The confidence has increased in the companies, but the shareholders are willing to pay more for the companies, probably because of the increase in the profits of 2019. Then moving on to our next ratio, that's earnings yield. It shows in percentage of each dollar invested in the stock that was earned by the company. Earnings yield is EPS over share price multiplied by 100. Earnings yield, as the name suggests, is the yield, is the amount that the shareholder investment has earned in terms of currency. It will tell us how much each dollar invested by the shareholder has generated the return for obviously himself. Let's put that in our chart extract. We've got an earnings yield. That is EPS over share price. The EPS for 2019 was 0.102 divided by share price is 3, and if this ratio is in times, so we got a 3.4 times, and doing the same for 2018, 0.02 divided by 2 is then 4.1. So the earning yield has fallen from 2018 to 2019 with 0.7%. It's from points perspective, it's not very significant. However, when we talk about the currency or dollars perspective, this can create a significant increase or decrease, as in this case in 2019. So the earning yield have decreased, which means that the expected generation, which was the last year, the company has not utilized its dollars invested by the company. That is, the company has not came up to the mark when it comes to hopes of the shareholders, because we are not comparing the actual fund, we are comparing the share price. Share price can increase with increased confidence. The shareholders are more in this bottom line. Shareholders were more confident the company will be generating more revenue, and that's why they have start buying the shares, and which has increased the share price. But when we used an earning yield formula on it, we see that there's a decrease. Obviously, their expectations are a bit higher in today 2019 as compared to the last year. After that, we have got our sixth ratio, that is dividend payout. This ratio indicates the amount of percentage dividend paid by the company in relation to earnings. Now, dividend payout ratio is computed with DPS over EPS, or total dividend divided by total earnings. We can use either formula for computation of dividend payout ratio. A clever student would get an idea in this that we already know the dividend payout ratio, but first let's compute that, and after that you'll get an idea what I'm talking about. Dividend payout ratio is DPS over EPS. We already computed our DPS, if I'm not mistaken. Yeah, we computed our DPS in the third ratio, that's in the dividend yield ratio. It was 0.0513 divided by EPS. We already know the EPS is 0.102. This becomes 50%. Doing the same for 2018 is 0.413 over 0.082. Give you 50%. Now there's a tie. Dividend payout ratio is 50%. If you remember that, this is also our assumption. When we use this ratio to compute our dividend cover, we took this assumption that 50% of our profit after the company's policy is to pay 50% of the profit after tax to the shareholders. Dividend payout ratio basically shows how much in terms of percentage the companies pay as dividends to shareholders. So it's obvious that our answer was 50%. A clever student who pays attention would obviously have picked this point. Moving on to our last ratio, that is total shareholders return, and one of the most important ratio in the whole of the category of the ratios. We call it the king of ratios when it comes to the FM syllabus. But still, it sometimes is not examined, so it's not from exam perspective it can or cannot come, but it is one of the most important ratios. Let's read out. Total shareholders returns indicates the percentage, this ratio is in percentage, the return that the shareholders will get considering both dividend and capital gain. Now shareholders, when they invest their funds in our company, they get return in two forms, either from the dividend or from the capital gain. Capital gain stands for the increase in market value. Example, if they have purchased our shares for $10,000, number of shares for $10,000, and now their value will increase, the same proportion of shares now value at, for example, $12,000. So they, despite the fact that they have done nothing, they have just kept the shares, the company performed well and the market can observe that. So this has increased the value of the share price, and in terms the shareholders net worth is has increased from 10,000 to 12,000. Now if we can compute that with them in our handy course extract, we need some space for this. Let's move downward. That's total shareholders return. Now formula is quite big if you ask me. That's current dividend per share plus current share price, that's C, that's previous share price divided by previous share price multiply by 100. Don't mind my writing. We need to go a bit downstairs to compute that. So current dividend per share is 0.0513. that is dividend is taken out, divided by total number of share, we get a DPS. We have already computed that in our dividend payout ratio. After that, we need to current share price is 3, previous share price we already know was 2.5 divided by previous share price for 2.5, and this becomes 22%. Doing the same for 2018 is 0.0413, that's 2.5, that's 2, divided by 2, this becomes 27%. So the total shareholders returns compare while taking both the elements, that is shareholders capital gains and the dividend, combining them in this ratio, the total shareholder return has decreased. The investment has decreased in value. That is the bad news for the shareholders, but that is what this ratio shows, that the total shareholder returns taking both the capital gain and the dividend gain into account, the total wealth of the shareholders has decreased. The company has need to do more when it comes to increase in shareholders wealth maximization. That was our corporate objective, if you remember from the last video. So that is for the ratios. Thanks for watching.